Insurance policy provisions. An insurance policy is the contract that a life insurance company issues when it enters into an insurance agreement. The policy, along with any amendments, is also known as the insurance contract. These legal documents have certain characteristics common to most policies. It's worth noting that individual, group, and accident and sickness insurance have similar, but slightly different, statutory provisions governing them. This chapter provides an overview of parties to an individual policy, formation of the policy term, and termination of a policy, assignment of a policy. The chapter also reviews specific provisions for different types of life insurance, including individual, group, and accident and sickness insurance. Additionally, it covers other products that legally qualify as life insurance but don't resemble traditional policies, such as annuities, segregated funds, also known as individual variable insurance policies, IVIC, registered retirement and pension products. These specialized products are subject to specific regulations, and their contract terms and conditions must meet regulatory requirements to qualify for preferred tax treatment. Parties to an individual policy. Individual life insurance contracts are made between an insurer and a policyholder, also known as the insured. Other individuals may be involved or derive rights from the contract, such as the life insured, the beneficiary, a contingent beneficiary, a successor owner, or an assignee. The insurer. The insurer is the life insurance company that takes on the risk and issues the policy. The responsible insurer may change over time due to corporate mergers or acquisitions, in which case the rights and obligations are transferred to the new insurer. Regulators require the new insurer to issue certificates of assumption to affected policyholders. The policyholder. The policyholder is the individual or legal person, such as a corporation, who has legal ownership of the policy and exercises its contractual and statutory rights. The person who makes the original contract with the insurer is the first policyholder. A policyholder can own insurance on their own life or on the life of someone else, like a spouse, child, or parent. A policy can also have co-owners. Co-owners may have a separate private agreement outlining their rights and responsibilities, which is distinct from the insurance policy. Successor policyholder. If the policyholder dies before the insured person, ownership of the policy is transferred to a new owner. The policyholder can identify this new owner in advance in the policy or through an amendment. This person is called the successor policyholder. If no successor is named, the new owner will be the policyholder's estate and its beneficiaries. Life insured. The life insured is the person whose life is insured and on whose death the benefit is paid. To be valid, the policyholder must have an insurable interest in the life of the life insured at the time the policy is issued. Beneficiary. A beneficiary is a person for whom insurance money is payable. The ability to designate a beneficiary is enabled by provincial and territorial insurance statutes. Beneficiaries have rights under the policy but are not a party to it. If there is confusion over who is the rightful beneficiary, agents should advise clients to seek legal advice. Designating certain individuals as beneficiaries can protect death benefits and the policy from seizure. These individuals are known as protected or family class beneficiaries and include a spouse, including common law, child, grandchild, and parent of the life insured. A policyholder can name or change a beneficiary using a form from the insurer, unless the existing designation is irrevocable. Beneficiary designations must be in writing and can also be found in documents such as a will. Irrevocable beneficiary designations. A policyholder can make a designation irrevocable, but the declaration must be filed with the insurer's head office to take effect. An irrevocable beneficiary's consent is required to change or revoke the designation, or to withdraw policy cash, take loans, or surrender the policy. An irrevocable designation, even if the beneficiary is not a preferred class member, also makes the policy exempt from execution of judgment and seizure. Legislative definition of beneficiary. Provincial insurance legislation defines a beneficiary as a person other than the insured or their personal representative. The executor or estate trustee does not meet this statutory definition for insurance proceeds payable to the estate. Policyholders who do not meet the legislative definition of beneficiary receive the insurance money in their capacity as the owner of the policy. In common law jurisdictions, the relationship between the life insured and the beneficiary, not the policyholder and beneficiary, is what is crucial for creating creditor protection. Contingent beneficiary. A contingent or secondary beneficiary can be named to receive proceeds if the primary beneficiary dies before the life insured. If there is no valid primary or contingent beneficiary designation, the proceeds will be paid to the current policyholder or their estate. Group insurance policies. Group insurance is a single policy, a master policy, that covers a defined pool of individuals, such as employees or members of an association. Plan sponsor. Group plans are arranged by a plan sponsor, which may be an employer, a union, or a professional association. The sponsor, also called the group insured or group policyholder, is the entity that contracts with the insurer. The insurer providing group benefits contracts with the plan sponsor, not with each individual group member. Members. The person whose life is insured is known as the group life insured. Plans define who is eligible for coverage, and this can include members and their families. Mandatory membership in a group plan helps the insurer maintain a constant number of lives for premium calculation and prevents anti-selection. Beneficiaries. Group life insureds can designate beneficiaries to receive their insurance benefit, even though they are not parties to the master policy. Formation of policy. In common law, a contract is formed when there is an agreement on the subject matter and an exchange of value. With life insurance, the insurer promises to pay a defined benefit if the premium is paid. Offer and acceptance. The process of forming a contract involves an offer and acceptance. In Canadian common law, the insurer's delivery of the policy constitutes the offer, and the applicant's decision to accept it is the acceptance. Application for insurance. The application form is an important part of forming the policy. It's crucial for the agent to help the applicant answer questions correctly and not paraphrase them, so the risk can be adequately assessed. The answers in the application are the benchmark against which changes in insurability are measured. Temporary insurance. An applicant can obtain temporary coverage during the underwriting process if they meet certain health criteria. This coverage typically lasts for 90 days and expires once the policy is approved or declined. Changes in insurability. If there is a change in insurability between the application and policy delivery, the policy does not take effect. Both the policyholder and the proposed insured have a duty to disclose any known changes in insurability to the insurer before the policy is delivered. Delivery of policy. The policy is not in force until all delivery requirements are met and the first premium is paid. If the first premium was submitted with the application and accepted, the insurance becomes effective on the date determined by the insurer. If the policy is cash on delivery, it's not in force until the payment is received after delivery. Term and termination of policy. A policy can be annulled, canceled, or expire. Rescission, 10-day free look. When an individual policy is delivered, the policyholder has a 10-day free look period to review the policy and confirm it meets their expectations. During this time, they can return the policy for a full refund, effectively rescinding the contract at surrender. Individual life policies are unilateral contracts, meaning the policyholder can cancel the policy at any time. Surrendering a policy results in a complete termination of rights for both the policyholder and any beneficiaries. If the policy has a cash surrender value, CSV, it will be paid out after termination. Expiry or termination. A policy may simply terminate in accordance with its terms. For example, a term life insurance policy has a finite duration after which it expires. Termination by the insurer. In certain situations, an insurer can cancel a life insurance policy before it expires. These reasons include fraud, misrepresentation, or concealment. Non-payment of premiums. Fraud, misrepresentation, or intentional concealment. An applicant commits insurance fraud by making a deliberate misstatement, intentionally omitting a material fact, or obtaining insurance for which they don't qualify. Unlike misrepresentation and concealment, fraud includes the intent to mislead the insurer. The incontestability period does not apply when fraud is involved. During the application process, if an applicant misrepresents factual information, the insurer may adjust the proposed coverage or decline the application within the first 2 years. If a good faith misrepresentation or concealment is discovered within the first 2 years of the policy, the insurer can cancel the policy. This is known as the statutory incontestability period. If the insurer doesn't cancel, it cannot do so later for that same misrepresentation or concealment. After 2 years, once a policy has been in effect for 2 years, the insurer can only cancel it based on fraudulent misrepresentation or concealment. An insurer can cancel a policy for fraud at any time, even when a death claim is made. Non-payment of premiums. For sickness or accident insurance, the policy remains in force until a registered written notice of termination is mailed to the policyholder's address. The termination takes effect 10 days after the notice is mailed. For life insurance policies without cash values, non-payment of premiums will result in termination after a 30-day grace period. However, the insurer is obligated to reinstate the policy if the client applies within 2 years of cancellation and the insured still meets the insurability conditions. Assignment of a policy. Absolute assignment. An absolute assignment is the transfer of policy ownership by the policyholder. This is considered a disposition for tax purposes and can result in taxable gains for the assignor. The new owner has all the rights of the original policyholder, including the right to designate a new beneficiary or withdraw money. The right to assign a policy is not unlimited in all jurisdictions, as some prohibit the trading of policies, e.g., viatical settlements. Collateral assignment. Some permanent policies with substantial cash surrender values can be used as collateral for a loan, which is known as a collateral assignment. The policyholder assigns ownership to the lender only as collateral, which restricts them from taking actions that could affect the security's value. When the loan is repaid, full ownership reverts to the original policyholder. Product-specific policy provisions. This section reviews the specific policy provisions for various insurance products. Individual life insurance. All individual life insurance policies contain basic provisions required by provincial law to define the coverage and cost. These provisions are typically summarized in a policy particulars page and include the name or description of the insured and the life insured, the amount of insurance proceeds and the conditions for payment, the premium amount and any grace period, whether the contract participates in a distribution of surplus or profits. Conditions for reinstatement if the policy lapses, options for surrendering the contract, obtaining a loan, or getting paid up or extended insurance. The documents that constitute the entire agreement are the application, the policy, any attached documents when issued, and any subsequent written amendments. Reduction. Some policies have a death benefit that reduces as the life insured reaches a certain age. Exclusion. An exclusion is a change to the coverage where a death caused by the exclusion would not result in a policy benefit. Exclusions can be contractual or imposed by law, such as when a beneficiary causes the risk insured against. Pre-existing condition exclusions. These are more common in disability insurance and exclude benefits for a disability related to a medical condition that existed before the insurance was applied for. Suicide clause. Most individual policies will pay a death benefit if the death is caused by suicide, but only if it occurs after the policy has been in effect for a stipulated period, typically 2 years. Living benefits. Some policies allow the policyholder to receive an advance payment of a portion of the death benefit if the life insured is diagnosed with a terminal illness. Cash surrender value, CSV. Some permanent policies build up cash values. If the policy is canceled, the amount received is the cash surrender value, CSV, which is reduced by policy loans, unpaid premiums, or surrender charges. Group life and health insurance. Group insurance is a single policy that covers specified people and their eligible dependents. The plan sponsor or group policyholder contracts with the insurer and determines the benefits. Administrative services only, ASO. Some large employers self-insure their employee benefits and hire an insurer to process and administer claims on their behalf. These ASO plans are not insurance plans and are not covered by provincial statutes, certificates. When members join a group plan, they receive a certificate from the insurer, delivered by the employer, that contains individualized information about their coverage. Booklets. Plan sponsors may also use booklets to explain group benefits, but these are only summaries and not the actual insurance policies. Group conversion privilege. When a group member leaves the plan, they have a group conversion privilege to convert their group life insurance into an individual policy without underwriting if they are under age 65. This right must be exercised within 31 days of the termination of their group coverage. Individual and group accident and sickness insurance. This type of insurance can be an individual or group contract and can cover risks like accidental death and dismemberment, AD&D, disability drug insurance, critical illness, CI, long-term care, LTC, AD&D. This insurance covers physical loss or death due to an accident. The policy defines what constitutes an accident and has many restrictions and exclusions. Disability. Individual disability insurance can be complex, covering full, partial, temporary, or permanent reductions in the ability to earn income. A policy may include a future income option, FIO, which allows the policyholder to increase coverage without medical underwriting. Critical illness. This insurance pays a lump sum if a person is diagnosed with a covered life-threatening illness and survives for a period, usually 30 days. Long-term care. LTC insurance provides a benefit when an insured person cannot perform daily living activities or requires constant supervision due to deteriorating mental functions. All disability and LTC plans have a specific waiting period, such as 30, 90, or 180 days, before benefits are payable. Statutory conditions. Unlike life insurance, statutory terms and conditions must be included in every individual accident and sickness policy for it to be valid. Annuities. Annuities are policies from insurers or financial institutions that pay a fixed amount over a specific period. Annuity contracts are considered life insurance contracts under provincial and territorial legislation. Annuities can be individual or group contracts and can be registered or unregistered, deferred, or immediate. Parties. The parties to an annuity policy are the insurer, the annuity provider, the policyholder, the annuitant, the measuring life, and the designated beneficiary. For registered contracts, the policyholder, annuitant, and payee are all the same person. Structured settlements. These are a special type of single premium annuity that is non-assignable, non-commutable, and non-transferable. They provide a customized stream of payments to fund a settlement, and the payments are not considered taxable income to the recipient if designed correctly. Segregated funds. An individual variable insurance contract, IVIC, is an individual annuity contract related to segregated funds. The premiums are invested in segregated funds managed by the insurer, and the policy's value varies with the investment value. These policies guarantee to pay at least 75% of the premiums paid on death or maturity before age 75, even if the investments are worth less. IVICs are governed by insurance legislation, not securities law. Instead of a prospectus, insurers must provide an information folder at the point of sale. Segregated funds are also available through group annuity contracts, but they do not have the same guarantees. Pension products and other group annuity products. Group annuity contracts are governed by insurance and tax legislation, as well as CLHIA's Guideline G12 for capital accumulation plans. Pension funds are primarily governed by the relevant Pension Benefits Act. The two main types of pension plans are Defined Benefit Pension Plan, DBPP, a plan where the pensioner's entitlement is based on a formula related to income and years of service, not the plan's financial performance. Defined Contribution Plan, DCPP, a plan where benefits are determined by member and employer contributions and investment performance. Pooled Registered Pension Plan, PRPP, is a new type of plan for self-employed individuals or those without an employer-sponsored plan, designed to lower costs through pooled contributions and professional management. Other products. Other products offered by insurers such as tax-free savings accounts, TFSA, registered retirement savings plans, RRSP, registered retirement income funds, RRIF, locked-in retirement accounts, LIRA, and life income funds, LIF, are created by modifications to the Federal Income Tax Act to encourage saving for retirement. These products may be offered through group or individual contracts. Deferred Profit Sharing Plan, DPSP, a retirement savings vehicle where employers distribute company profits to a plan for the benefit of employees, TFSA, a savings account where deposits are not tax-deductible, but income and withdrawals are tax-free. The holder can designate a beneficiary. If the beneficiary is a spouse, they can become a successor plan holder. RRSP offers flexibility for unrestricted withdrawals at any time, but recontribution is not permitted. RRIF, a retirement income payout plan that offers the greatest opportunity for income deferral and flexibility for withdrawals. LIRA, a type of registered retirement savings plan for funds transferred from a pension plan, where holders are generally unable to withdraw amounts before age 55. LIF, a retirement plan where minimum and maximum annual income amounts are subject to provincial pension laws.